Your bank is not your friend. That's not an opinion. That's a business model. Every single time you swipe your card, deposit a paycheck, keep money in a checking account, or overdraft by $3 at 11 p.m. on a Tuesday, your bank is making money. Most of it without you noticing. Some of it in ways that are technically disclosed in a 47-page agreement you signed without reading. This video is about exactly how that works. Not to make you paranoid, to make you informed. Because once you understand the four main ways your bank extracts money from your everyday behavior, you'll start making different decisions, and your bank will make slightly less money off you specifically. My name is Rick. I explain how financial systems actually work, not how they're marketed to you. If that's useful, the like helps this reach more people. Let's get into it. The first and most invisible way your bank makes money from you is through something called the net interest margin. Here's the mechanic. You deposit money into a savings account. Your bank pays you interest on that deposit. In 2024, the average interest rate on a traditional savings account at a major U.S. bank was 0.46% annually. So if you have $10,000 sitting in a Chase or Bank of America savings account, you're earning about $46 a year. Meanwhile, your bank takes that same $10,000 you deposited and lends it to someone else, maybe as a personal loan at 11%, maybe as a credit card balance at 24%, maybe as a mortgage at 7%. The bank borrows money from you at 0.46% and lends it at rates between 7% and 24%. The difference between those two numbers is called the net interest margin, and it's the core engine of how banks make money. In 2023, J.P. Morgan Chase reported a net interest income of $89 billion. That's the profit from this one mechanism alone, borrowing cheap from depositors, lending expensive to borrowers. The depositors are you. The borrowers are also, in many cases, you. The practical implication of this is simple. Every dollar you keep in a traditional savings account at a major bank is a dollar the bank is using to earn 7 to 24% while paying you less than 0.5%. A high-yield savings account at an online bank pays 4.5 to 5% on the same money. The spread between what you're earning and what you could be earning on $10,000 over 5 years is approximately $2,200. Not because of any complex strategy. Because of which account you chose to leave the money in. The second mechanism is interchange fees, and this one is completely invisible to most people because you never see it on your statement. Every time you swipe or tap a credit or debit card anywhere, the merchant on the other side pays a fee. For credit cards, that fee is typically between 1.5% and 3.5% of the transaction. For a $100 purchase, the merchant pays somewhere between $1.50 and $3.50 to the card network, Visa or MasterCard, and your bank. That fee gets split between the network and the bank that issued your card. This is why your bank loves when you use your card instead of cash. Cash transactions earn them nothing. Card transactions earn them a percentage of every single purchase you make, every single day, from every single merchant. It's also why rewards cards exist. Banks can afford to give you 2% cash back on groceries, because they're collecting 2.7% from the grocery store on the same transaction. The rewards are not generosity. They're a portion of what the bank is already extracting from the merchant, returned to you to incentivize continued card usage. The math works out because people who use rewards cards spend more, an average of 12 to 18% more than people paying with cash or debit, according to consumer behavior research from the Federal Reserve Bank of Boston. The moment you understand interchange, the card rewards program looks different. You're not getting something for free. You're getting a rebate on a tax that was already baked into the price of everything you bought. The third mechanism is fees. And this category deserves more attention than it usually gets because the numbers are genuinely large. Overdraft fees are the most discussed. The typical overdraft fee at a major U.S. bank is $35 per transaction. If you spend $3 more than you have in your account, your bank covers the $3 and charges you $35 for the service, an effective interest rate of over 17,000% annualized if you pay it back within 2 weeks. In 2022, U.S. banks collected approximately $8 billion in overdraft fees. That number dropped significantly after regulatory pressure and some banks eliminating the fees, but it's still in the billions annually. Monthly maintenance fees are less dramatic but more consistent. The average checking account at a major bank charges $12 to $15 per month if you don't meet minimum balance requirements. That's $144 to $180 per year for the privilege of keeping your money somewhere. Many people pay this fee every month without noticing because it's debited automatically and doesn't show up as a line item they consciously approved. ATM fees layer on top of both. Using an out-of-network ATM typically costs $3 to $5 from your bank, plus an additional $2 to $3 from the ATM operator, so $5 to $8 per transaction. If you do that twice a month, you're paying $120 to $192 per year in ATM fees alone. Wire transfer fees, foreign transaction fees, paper statement fees, stop payment fees. Each one is individually small. Collectively, they represent a significant annual extraction for anyone who isn't actively managing their account against the fee schedule. The fourth mechanism is data, and it's the newest, the least visible, and in some ways the most significant. Your bank has a complete record of your financial life. Every transaction, every merchant, every amount, every frequency. They know where you shop, how much you spend on food versus entertainment versus healthcare, whether your income is stable or variable, and whether you tend to spend impulsively after payday. Banks use this data internally to make lending decisions. Your transaction history is more predictive of creditworthiness than your credit score in many cases, which is why banks with checking accounts sometimes offer better loan terms to existing customers. But data also has external value. Banks sell aggregated and anonymized spending data to retailers, advertisers, and research firms. The exact terms vary by institution and are disclosed in the privacy policy that no one reads. The practical implication is less about direct financial loss and more about understanding the nature of the relationship. Your bank is not a secure vault where you store money. It's a data company that also holds your money, and the data you generate by using the account is part of the value exchange, whether you consciously agreed to that or not. So here's the complete picture. Your bank earns net interest margin on the difference between what it pays you on deposits and what it charges on loans. It earns interchange fees every time you swipe a card. It earns fee income from overdrafts, maintenance charges, ATM usage, and a list of smaller items. And it earns data value from the complete transaction record your account generates. None of this makes your bank evil. Banks provide real services, the ability to store money securely, make payments, and access credit. The question is whether you're aware of what the service actually costs and whether the specific account you chose is the best deal available to you. A high-yield savings account at an online bank pays roughly 10 times more interest than a traditional savings account. A credit union typically charges lower fees than a commercial bank. A no-fee checking account eliminates maintenance charges entirely. The infrastructure of options that costs you less already exists. The only thing between you and it is the default you chose when you were 18 and never reconsidered. Your bank is not keeping this information from you. It's in the account agreement. It's in the fee schedule. It's just presented in a format that assumes you won't read it. And statistically, you haven't. If this changed how you think about where your money sits, the like helps this reach people who are paying fees they don't know about. And if you want to understand the specific mechanism behind why credit card interest compounds the way it does, and why the minimum payment is designed to keep you paying for years, that's next.